Late afternoon, October 28, 1929, Charles Mitchell, head of the nation's largest bank, returns to his office facing a nightmare. His trading chief delivers a terrifying discovery. In the chaos of a plunging market, the bank's own automated systems had been mindlessly buying up their own plummeting stock. National City had accidentally amassed over 70,000 shares. Mitchell knows the math. The bank lacks the cash to cover the purchase. If the public realizes National City is insolvent, depositors will storm branches across the country, triggering a catastrophic bank run. Mitchell and his peers were viewed as masters of the universe who never panicked. Yet, as the crash began, these powerful bankers were paralyzed and entirely at the mercy of the machine they had built. This paralysis was a radical departure from the panic of 1907. 20 years prior, Wall Street possessed a proven, centralized playbook for halting financial crashes. That playbook was J.P. Morgan Sr. The ultimate financial dictator, Morgan personally intervened to stop the 1907 collapse through sheer force of will. Morgan famously locked the nation's top bankers inside his private library. He sat by the fire, playing solitaire, refusing to let them leave until they agreed to a coordinated bailout plan. The leaders of 1929 believed they had inherited Morgan's absolute power. Why then did the locked-in-a-room strategy fail so completely 22 years later? Between 1907 and 1929, the American economy mutated. A newly normalized product, consumer credit, transformed how the country functioned. Corporations like General Motors broke cultural taboos by selling cars on installment plans. They conditioned the middle class to buy today and pay later. This debt habit jumped to Wall Street through margin trading. Everyday citizens began putting down a fraction of a stock's cost and borrowing the rest to buy more. The mania infected everyone. Actors like Groucho Marx took stock tips from hotel elevator operators, turning Wall Street into a worldwide obsession. By 1929, Wall Street had swollen into a sprawling, decentralized machine, fueled entirely by the public's borrowed optimism. To capture this flood of public money, Thomas Lamont and his partners at J.P. Morgan engineered complex new financial instruments. Their dangerous innovation was the investment trust. These trusts used public money to buy stocks, then issued debt against those stocks to buy more, stacking interlocking layers of leverage. This amplifies gains, but a minor dip in foundational value wipes out the entire structure. The smartest men on Wall Street had engineered a financial structure so layered and fragile that they could no longer calculate its risk. They were trapped inside their own creation. In late October 1929, the market began to crack. Selling volume reached such a pitch that it physically overwhelmed the human apparatus of the trading floor. The ticker tape fell 4 hours behind. For the traders on the floor, the numbers displayed on the big board were entirely fictional. The market was flying blind. Traders held assets but possessed no idea what they were actually worth. In that vacuum, panic became the only response. Confidence is the sole lifeblood of a leveraged economy. The moment data fails and certainty vanishes, the illusion of value evaporates. Charles Mitchell tried to play the great man one last time. He personally borrowed $12 million to buy National City stock and halt the slide. Mitchell's secret bailout was a futile echo of J.P. Morgan's 1907 triumph. He was throwing personal millions into a macroeconomic tsunami that was wiping out fortunes across the globe. The crash proved that unchecked debt eventually creates a system too large for any individual to control. Bankruptcy arrived exactly as Hemingway described, gradually and then suddenly.